Today, let us delve into the evolution of America's economy with a critical eye on the dynamics of our labor force and national debt over the past decades. In 1980, the U.S. boasted a labor force of 91 million individuals and a national debt of $960 billion. Fast forward to today, our labor force has surged by approximately 78%, now encompassing about 162 million people. Meanwhile, our national debt has skyrocketed to an astounding $34.7 trillion. This staggering increase raises serious questions about the economic policies and decisions that have guided us to this point. The decision to decouple the US dollar from gold in 1971 under President Nixon was celebrated as an economic liberation. It aimed to unleash the formidable economic potential of the United States. Yet the stark reality we face today, a 3,500% surge in national debt, tells a tale of fiscal recklessness and an over-reliance on debt-driven growth. The current debt burden, which translates to an overwhelming $475,211 per new worker, heavily weighs on individuals, compelling many to juggle multiple part-time jobs just to survive. This distressing scenario vividly illustrates why the market for part-time employment is booming as full-time opportunities dwindle. Moreover, while the current Consumer Price Index (CPI) shows a moderate increase of 3.5%, hinting at controlled inflation, this number is misleadingly incomplete. If we were to use the inflation measurement methods from 1980, the effective inflation rate today would be an alarming 12.5%. Inflation once peaked at 14%, prompting Federal Reserve Chairman Paul Volcker to aggressively hike interest rates up to 20%. This move briefly hamstrung the economy but was crucial in curbing inflation, gradually restoring the eroded purchasing power back to American citizens. We are at a critical point where fundamental economic principles appear overlooked by our current political leaders. With the national debt escalating by approximately $1.6 trillion every quarter, urgent and severe actions are required. Viable solutions could involve drastically raising interest rates, making significant reductions in government spending, and accepting considerable economic discomfort. This paints a sobering picture. The eroding purchasing power of the American dollar, a consequence of unchecked fiscal policies, continues to outpace income growth, dimming the prospect of economic relief in the near and distant future. To stave off the looming financial crisis, we urgently need a radical overhaul of our economic strategies. It's crucial to rigorously analyze and revamp the policies implemented by our current political and economic leaders. History offers clear warnings, from Germany's devastating hyperinflation in the 1920s to Venezuela's current economic collapse, showcasing the dire consequences of economic mismanagement. These historical precedents must shape our strategy, compelling us to forge robust, sustainable economic policies that fully harness and bolster the productive power and resilience of the American economy. In conclusion, it is imperative, not merely advisable, that we change direction. We need to replace the current crop of leaders, whom we ironically dub mathematical geniuses, with genuine experts who have a proven grasp of economic principles. This decisive action is critical to fortify our economy, making it resilient and equipped to navigate and overcome the challenges that lie ahead.